Good morning, everyone, and welcome to our DAT IQ Weekly Market Update. This is our update for May 24th, 2022. I'm Ken Animo, Chief of Analytics here at DAT, joined, as always, by Dean Croak, who's our Principal Industry Analyst, Ned Damon, Principal Data Scientist, and a very special recurring guest. We have Dr. Chris Kaplis, who is our Chief Scientist. Good morning, everyone.
Good morning.
I wonder if most viewers were wondering if I got fired or if I was just on hiatus. That was the question I was wondering driving in this morning.
You're out on parole.
I'm out on parole. No, it's been great to watch the shows the past couple of weeks. I've been all over the place, but I'm really happy to be back in my studio and doing this with you all. So for those unfamiliar, we're here every Tuesday at 10 a.m. Eastern, 7 a.m. Pacific, talking about trends in the freight market, what we're seeing, but most importantly, answering your questions. So go ahead and get those questions in, and we will answer them towards the end of the show. But to get things rolling, I'm going to go to our key points of the week. So, much to the chagrin of the bloodbath-loving crowd, spot rates reversed course a bit last week. We do think that's most likely going to be a bit of a temporary plateau due to road check week. It'll be really interesting to see if we can get some of that seasonal upward pressure to pull us through to the 4th of July holiday, something we'll be watching very closely. Again, load post volume surged. We saw a pretty substantial dip in equipment posts, as you would expect during road check week. And then we have some really interesting things going on with contract rates, which is why Chris Kaplis is here to talk to us about that towards the end. And then falling drayage rates and import volumes in Savannah push owner-operators back to large fleets. So a lot going on. And to help explain that, I'm going to turn it over to Dean to go through our market update. Dean?
Yeah, thanks, Ken. Yeah, we're seeing this sort of migration of capacity between different markets, like particularly in the drayage market, the JOC we're reporting on last week. Great article by Ari Ash if you can get your hands on it. So let's start off with our market update this week. Have a look at our dry van load to truck ratios. No surprise that carriers took time off last week. They usually do when the 72-hour safety blitz kicks into force. With no idea on the results just yet. They'll be out in a month or so. Last week was no exception. Load posts were down. Equipment posts, were down about 16% week over week. Interestingly, it was more than double the average decrease during the last 5 previous road check weeks/years. As a result, the load to truck ratio almost doubled from 3.44 to 5.60. Similar effect in the refrigerated capacity almost. A lot more, typically each year, a lot more reefer carriers take time off compared to flatbed and dry van. So predictably, load posts volume surged as capacity tightened. Equipment posts dropped about 18% last week. Load post volumes typically do start to pick up ahead of Memorial Day long weekend coming up. Of course, it's the official start of the 2022 grilling season, which runs through to Labor Day. The load to truck ratio more than doubled to 11.5 loads per truck in refrigerated. And in flatbed, after dropping 18% the week prior, load post volumes increased by 8% last week. But it's still 6% lower than last year and about 21% higher than 2018. Flatbed carriers also took time off last week. Equipment posts were down 12%, which was almost double the week-over-week decrease during last year's 72-hour safety blitz. As a result, the load-to-truck ratio on flatbed bounced back to 70.41, up from 57.56. Having a quick look at our markets today, capacity was noticeably tight in the southeast region last week, where produce season is underway. Again, no surprise there. A lot of reefer carriers that haul dry van freight typically move over to the produce sector where the rates are better. In the southeast region, where produce season is underway, line haul rates increased for the 4th week in a row, up 8 cents a mile to a regional average of 208. Jacksonville had the most significant week-over-week increase. Rates were up 15 cents a mile to $2.05. That's excluding fuel. For outbound loads, capacity was also tight in the port market of Charleston, South Carolina. Spot rates in dry van jumped 17 cents a mile to an average of 264. Loads 320 miles west to Atlanta were down slightly last week to an average of 281. That's 13 cents a mile lower than this time last year. And quickly having a look on the West Coast, where produce season in Fresno is underway, the volumes are starting to ramp up after a prolonged sort of start to the season. It hasn't really picked up that much. Volumes are still down, but dry van capacity did tighten in Fresno. Spot rates are up 2 cents a mile to 213. And in Los Angeles, they've been decreasing for the 3 weeks prior. So a little bit of a change in capacity in that Fresno market there in the dry van sector. Having a look at the reefer market, staying in the southeast region, the Georgia peach season's underway. Volumes aren't anywhere near where they were this time last year. So growers are still finding plenty of reefer capacity last week. Spot rates were down 37 cents a mile to 447, excluding fuel. Loads from Macon to Orlando, it's a busy lane for produce out of that region, sitting at about $4.04, excluding fuel. That's about 10 cents per mile lower than this time last year. Loads north to Elizabeth, New Jersey, it's about 900 miles out of Macon. Spot rates are close to $1 a mile higher than the April average at 289. Ratecast is forecasting reefer rates on this lane to peak around $3.14 around Independence Day. And refrigerated capacity in Fresno, after dropping for the previous 3 weeks, capacity tightened last week, similar to the dry van situation. Spot rates are up 18 cents a mile to an average of 235. And wrapping up our market condition index view of the market with Los Angeles, flatbed carriers were in high demand last week. Rates are up 28 cents a mile to 269 after dropping for the 3 weeks prior. Very popular lane out of Los Angeles is Salt Lake City, about 700 miles northeast. Rates were down slightly last week, averaging 312. That's around 15 cents per mile lower than last year. Los Angeles to Las Vegas, currently averaging $4.16. That's 68 cents a mile higher than the previous year, while loads to Denver are down to 310, excluding fuel this week. That's about 20 cents a mile lower than the same week last year. So wrapping up with our year-over-year look at spot rates in dry van, after dropping 74 cents since the start of the year, dry van line haul spot rates, excluding fuel, reversed course last week, increasing by 4 cents a mile. This isn't unusual during road check week, so it's not a given this trend will reverse the long-term market correction, though we'll be anxiously waiting next week's results. The national average dry van line haul rate ended last week at $2.04. That's about 31 cents a mile lower than this time last year. In refrigerated sector, it's not unusual to see reefer rates begin to heat up this time of the year. Last week, rates were up 8 cents a mile. And again, that's the reefer line haul spot rate up 8 cents. The average was about 235. That's still 38 cents a mile higher than the previous year and about 13 cents a mile higher than 2018, when a similar number of carriers took time off during road check week that year. In the flatbed market, after dropping for the 5 weeks prior, flatbed spot rates reversed course last week, increasing just a penny per mile. National average was 261, excluding fuel. The flatbed spot rates are now 10 cents a mile higher than the previous year, or about 24 cents a mile higher than in 2018. So that's it for this week's market update. If you'd like to find out more about what's happening in the freight market, go to dat.com/market update and download our weekly report, which will be published on Wednesday evenings. And with that, it's over to Ned for the short-term forecast.
Hello, everybody. We're going to begin by looking at dry van forecasts. In blue, you can see the market rates observed by DAT, and then off to the right, you can see our varying forecast models. This week, it's turned up in a way that is similar to what Ratecast predicted, but I'm not going to break my arm patting myself on the back too hard there. Ratecast got the shape right, but the timing has been something that's been a little bit elusive, but I'm glad that the shape seems to be correct. Moving forward, in green, you can see the Ratecast model, which is expecting sustained growth, which may or may not happen, with rates rising back to about 220 a mile by the later part of June. In contrast, the short-term model expects that the worst is not yet over and that the ongoing trend will continue to trend downwards. I don't think that's quite as likely, but it is something to be aware of, and it has rates falling to about $1.85 by that same later part of June. Finally, in the middle, we have our two blended forecasts in gold and silver, which are mixtures of the two forecasts in different amounts and in different ways. They're sort of spanning the middle space with a slight downwards initial pressure before correcting upwards as we move into June, ending about where we are now at $2 to $2.05 a mile. Moving on next to reefer, once again, you can see in blue the market rates observed by DAT, and then off to the right, you can see that correction upwards. Ratecast in green is expecting some growth, but not quite as strong as it was expecting in van, with rates rising by about 5 to 10 cents soon, before stabilizing for a period and then heading up again as we head right near into the 4th of July. The short-term model in red is expecting that the downwards trend will assert itself once more, with rates dropping to about $2.10 a mile as we move into the later part of June. Finally, the blended forecast, which are mixtures of the two forecasts in different amounts in different ways, are expecting that current levels will more or less assert themselves, although they disagree about what the overall direction will be, upwards or downwards, with the gold blended forecast dropping by about 5 cents and the silver blended forecast keeping about where we are after an initial drop. Finally, into flatbed. It's funny how, despite the levels being so different, the shape of the overall graph recently has been very similar to what's been going on in reefer and dry van, which kind of an interesting observation. Anyway, moving on. In blue, you can see the market rates observed by DAT. Off to the right, you can see our forecast. The RateCast forecast is expecting that this recent upturn will sustain itself, with rates rising by about 7 to 8 cents over the course of the next month. The short-term model continues to believe that the worst is not yet over, with rates dropping by about 10 cents as we move into that same period. And the blended forecasts are a little bit more leaning towards the short term, although much more optimistic, with rates dropping by about 3 to 4 cents over that period. And with that, we're on to our DAT IQ question of the week, which is, when do you expect contract rates to turn downwards?
If only we had an expert on that kind of stuff on staff.
Only.
Yeah, I feel like I'm the only shipper representative here, because when you were talking about worst case, Ned, that's like best case. That's like happy days for shippers. Come on, this bloodbath. We like to bathe in these bloodbaths, right? For shippers. So here's the thing about the shippers see the early warning signs, the canaries in the coal mine, all that kind of stuff. The first one is when carriers start calling them saying, hey, we got trucks, because that's a big change from saying, hey, we don't have any trucks. And so that's the early sign. And then you see the primary acceptance ratio go up, and it's in the 90s now, high 90s for most companies, which means fewer loads are coming through the waterfall of the routing guide and spilling into the spot market, which means spot rates are going down. Although we didn't see in the FMIC the contract rates for shippers, we lag a little more than you guys do. We haven't seen the uptick for road check week, because to be honest, for large shippers, we've seen that the routing guide absorbs road check pretty well, so we don't see as much of a spot action there. But we are seeing contract rates starting to kind of even out, if you will. So we've seen the last, 6 weeks that the spot rates have been dropping mostly for large shippers, and the active rates are finally starting to drop. But we view it like a big bathtub, right? All the rates you have. And so 80 to 90% is contract. And when you have new entries into the market, it's either hot water, which increases the spot, or cold water, which decreases it. And so we're seeing that new rate differential. It's still a little warm. There's a lot of bids that were done in Q1 are starting to come in, and they weren't really expecting this, this decline that we've seen. So we're starting to see the contract rates change, and the same pattern that you showed, Ned, is what we see for shipper contract rates, kind of evening out. We don't see it dropping dramatically. We don't see it continuing to rise, kind of staying mellow. But I think it all depends on what happens later this summer with the China imports when the lockdowns end. Are we going to see a wall of imports coming in? Are we going to see fuel continue to stay where it is at high? So there's a lot of uncertainty, but we kind of agree with what you've been seeing, that the contract rates are going to start leveling out. Not a big decline, but kind of balancing out.
Something that Dean pointed out this morning. Oh, sorry. Go ahead, Ken.
No, go ahead, Ned.
Something that Dean pointed out this morning on the sign of negative pressure in the spot market is the harvest, the produce season. It's been way under. Dean, do you have those numbers that you were just talking about?
Somewhere in the order of 20% lower. There was about 20,000 fewer truckloads of produce moved last week, so it's significant. Mostly, that's going to be mostly coming out of California, most of that delta.
Is that because of poor harvest or changing demand?
Well, I'm not sure it's demand. It's more to do with a slower season, a slower start to the season, a longer season last year. Water restrictions are a really big part of this, Chris, on the West Coast, and fewer acres planted.
Yeah, I mean, that drought is bad. I mean, it's like a 100-year drought they're facing down there right now, stretching from Vegas down into Southern California. The pictures of Lake Mead are kind of, I mean, they're finding bodies, right? All the 1970s mob. It's no bueno. So we were actually at, last week, one of our customer appreciation events. We called our executive symposium. What was it, Chris and Dean? Like 50 to 60 of
Yeah, it was great.
Our largest customers. Yeah, it was awesome to see everyone the first time in like 3 years. But what you mentioned, you kind of buried the lead a little bit. I guess I wasn't prioritizing the import thing as front of mind as a lot of our big customers were. And that was a bit eye-opening to me as we, head into the fall. A lot of them thought we could potentially be in as dire of an inventory situation this fall as we were last fall, which, again, wasn't even a blip on my radar prior to that trip.
Yeah, I think just like last year, and Dean, I think you brought this up, the 4th of July post, usually you see a dip. It never really happened. Black Friday started on the 5th of July because all the shippers were advance buying. Retailers were getting stuff in so they could get them on the shelves. And I think that same thing might happen again, depending on when these imports finally get clear, because every shipper is still trying to get stuff in before, because they're planning instead of a 20-day transit time, it's a 40-day or a 60-day. So naturally, they're going to order sooner. So we'll see what happens. It might be the post-July or the end of July dip doesn't happen again.
Shanghai's out of lockdown, though. Is it just that there's a lot of built-up container traffic that we're waiting to clear through, or?
Yeah, they can't load. And so I think the big thing into China, and I'm not an expert here, is the trucking, because going from region to region, they get stopped. And so trucks have no incentive to leave their region because they'll get quarantined. And so there's not a lot of China moves, and a lot of companies are starting to shift things away as much as they can to avoid the quarantine and the lockdowns, because their ships just not getting loaded. There's more waiting off of China than there is waiting off of LA. Dean, I think you had a number. Last week you were talking about this, weren't you?
Yeah, it was 425 last Monday, vessels waiting off Shanghai and Ningbo ports.
Which is 4x what at the peak was waiting off of LA. Right? So
35 this week.
Yeah.
And the thing that I didn't think about was, I guess they're locking all these folks in the factories, so they're still producing, right? So there's not going to be like this production dip, right? There's going to be a mass release of goods to come over. So could be a boon over the summer, as you said, Chris, to keep, because what we're not seeing is a real big, if any, dip in volume outside of seasonal expectations, right? I mean, we're continuing to see million dry van load posts a week plus on our load board, which is just kind of like a barometer we use. I didn't check last week, Dean, but I have to imagine with road check, that's what it looked like. And then our contribution volumes are remaining right on track with what we would expect. Now, some of it is shifted to contract for sure, but total freight moved doesn't seem to be dipping in any sort of recessionary pattern.
And we might see more a dip or an increase rather in spot from shippers, because right now it's good hunting. Right now, if I have some high contracts and I might send enough volume to satisfy the contract I agreed upon, but anything above that, just like a carrier in a tight market will go to spot, so will a shipper in a down market. And also what we're seeing is more of this direct API connection for some business. So we're seeing more use of dynamic or spot, more than just failing routing guides. So that's kind of an increasing trend that we're tracking as well.
Yeah, I mean, so this was a broker-centric event we were at, and we had these breakout sessions, right? And one of the things that I learned a bit about was just how much contract volume was secured, whether it was through direct tender or even email tender, right? So brokers running more contract freight on the shipper side means more spot freight on the buy side, right? So if you think about the sell side as the shipper, the broker's got to go buy that transportation on the spot market mostly. So that's what I think has kept pretty healthy volumes in the spot market. I think the big wild card, though, is going to be fuel. I just can't make heads or tails of why we're not seeing fuel prices come down, even though we've seen some of the financial futures dip.
Well, it went down 4 cents a gallon. I mean, that's something.
That's something. That's less than a cent a mile.
Yep.
So I don't know. I mean, I think the question is, when the diesel does come down, do the share of line haul come back up? Is a question we're hearing asked a lot, and I don't know that we've got a history of that.
Yeah, it was 1.4 million loads last week, load posts on dry van, which was about 2% lower than this time last year.
So only 2% lower than the highest peak on record ever.
Yeah.
Interesting.
Listener questions.
We do.
Terrell asks, are diesel prices going down soon? Is there a shortage of diesel fuel?
No one knows. And there was just, Biden is going to release 1 million gallons or 1 billion gallons diesel he's contemplating from the northeast?
A day for 6 months. Yeah.
I have no idea what that will do. I don't know what our total consumption of diesel is. Will that be a blip? I have no idea.
I have no idea. I mean, ultimately, it just seems to be decoupled, right? I mean, these diesel prices are higher than when oil was this price before. I just don't know the underlying mechanics well enough to understand or give an educated thought on why we're still seeing diesel. What is it nationally, Dean? 545 or something?
557.
Yeah, 557.1, 5.571, down 4.2 cents this week.
Yikes! Yeah, I don't.
The funny thing is, so talking to shippers, the big thing for them is they had to revise their fuel surcharge card because no one uses a formula. They have to print it out, write a little schedule. They've had to reprint it like 4 times because they hadn't seen above $4 a gallon for when 2014,
16, yeah,
it was 16. So and then they had to do it for that, then do it for 5, above 5. So it's crazy.
Oh yeah, that's been kind of an interesting bit of feedback, right? Something, all the talks about rates falling, or you talk about reporting on a fuel adjusted basis. If you include fuel, rates are the highest they've ever been, period. Right? I mean, when you look at spot, contract, you name it, when you include fuel, so you're looking at it from a shipper's perspective, that's the most they've ever paid to move freight.
Yeah, and they have to absorb that. You can try and pass things on to the consumer, but it's hard to push that on. And so some carriers, if you're really fuel efficient and the shipper's paying a 6 mile per gallon escalator and you're like at 7, you're theoretically making money. So it rewards the more efficient fleets and penalizes the less efficient. And I think, and correct me if I'm wrong, Dean, that kind of correlates to the size of the fleet. Is that a fair statement?
Yeah, I would say so. There's probably got less aerodynamic technology on the older trucks that are owned, sort of certainly in the owner operator segment.
Yeah, so I think of all the headwinds we have right now in the market, fuel is the number one, and it's disproportionately affecting owner operators, small fleets, than it is for the larger fleets. So it's like a double whammy for them.
Yeah, I mean, again, if you're in a position where you have fuel recapture, so you're a big carrier, I mean, I don't know that you're feeling any of the real spot rate effects at the moment, right? I mean, you're seemingly just rocking and rolling, right? You've got ample volume, you've got record high contract rates. You're probably concerned about the expense on your empties, and you're probably concerned about the driver pay increases you just passed along the last couple of years. But other than that, you've got the shipper conceivably right where you want them. I would imagine is the overall sentiment.
So there's a question from Dan that I'd like to answer. He asked, would the shipper not be better to have a candid conversation with their incumbent carriers over going back to the spot market? Absolutely, and they will usually do that first. Honestly, yes. Just like a carrier will have that conversation as well, and they'll try to reach an agreement. Just like when the market's tight, a shipper and a carrier might agree to a slight increase so it doesn't go out to bid. You might have the same kind of discussion now. Yeah, absolutely. You'll have that certainly with your core carriers. Maybe not with your third tier, but yeah, absolutely. Yeah,
that's all. I think that was a bit of a leading question, knowing Dan. He knows that's the right way to do it.
No,
that was almost more sage. That was more sage advice. Blow up the routing guide. The routing guide is dead. Long live the routing guide.
Mihail asks, is it possible that reefer is actually bringing down rates for dry van carriers? For example, Lakeland to Charlotte lane for reefer carriers dropped almost $300 in the last 20 days.
Yeah, I just had a quick look at RateView at that particular lane. It's 582 miles, Lakeland to Charlotte. Refrigerated rates are actually up in the last 7 days, up about 20 cents a mile. So I think that may be changing because there's definitely coming up, and same with dry van too. So I think that's changed in the last week by the look of the data here. The last 7-day rolling average is up for both dry van and reefer, probably up more so for van at the moment.
Yeah, I think the one word of advice I would give, and this is not directed anywhere, I mean, this is just advice. This isn't kind of like, in this market, you're pretty much 50% of the time rates are going to be going up, and 50% of the time rates are going to be going down, right? We operate in this cyclic. So very, very rarely do you feel that moment when you're going on a roller coaster where you feel weightless? I mean, that happens very rarely in this market. So, rates coming down are not like this harbinger of the apocalypse where, you're going to be able to go buy a truck for $30, like you could in Venezuela. It's just not the way that it works. So, yeah, I mean, I think we are riding this kind of broad market cyclic down, right, in a corrective period, but we can still find upward pressure in the produce lanes for reefer, or for, if you're we were just down in Georgia near Club Car's world headquarters in Augusta, Georgia, and I mean, probably saw 15 golf cart carriers totally loaded, right? And this is the time they're all getting shipped out to the clubs up north. So if that's your market, none of this makes any sense to you, right? Because that's the hottest time, or when it's time for Vidalia onions, as Dean talks about, or watermelon. So I really don't think it's like reefer is dragging down the dry van market. I just think we're in this corrective period, but still, as we've mentioned, up considerably over where we were 2 years ago, which was, again, at that point, one of the hottest times on record.
Yeah, so that's a really good point, Ken. We're not a steady state market, and that's the really important. It's a pro and a con, right? The good thing is we know it's going to cycle. The bad thing is we tend to be idiots, and we think that what's happening today is going to continue, and so we forget that we're on a cycle. But that's something we can lean to, because what happens is, and shippers were guilty of this during the Q1, things had been going crazy, so they secured their contracts assuming it would still go crazy forever. And so they're planning on the past instead of thinking what's going to happen in the future. And no one can predict the future, but we live in a cyclical business. So we're at the top of the roller coaster. You're going to plan for coming down. So it's a hard thing to do, but we can lean on this cycle, this curve that we've witnessed over the last 15 years, 20 years, certainly since deregulation.
Yeah. And I mean, I know it's fun to talk about, right? I mean, markets that are moving both up and down are fun to talk about, but no one expected us to continue on the up and to the right trajectory forever. I mean, what's the logical conclusion there? Shippers are paying $10 a mile in 2025? Like what? Where do we arrive?
And unfortunately, some of those carriers who bought in at that paid the very expensive price for trucks and got in at the peak. They're going to be paying the price because they can't support. It's not sustainable. So again, you can't buy or procure based on the past. You have to think about what you think is going to happen in the future. You got to go where the puck's going to be.
One quick note on that, and that is, it is easy to understand the direction, but the timing is the really tricky bit. I know that we've predicted back in 2021 we were expecting rates to start falling again, and they didn't. They just kept kind of defying gravity, and that's one of the hardest things. Is at some point the market will revert, and being able to know when is very, very hard.
And that's why you should use DAT.
I agree, yes, but I will say that there's just a lot of fantastic case studies on the last one to get on a plane, the bumped flight that took an earlier flight to get home earlier than the plane crashes, right? Not to be morbid, but there's going to be the last person to walk into a Freightliner dealership. Or wait, which truck? You're a Peterbilt guy, so you don't like Freightliner, right, Dean?
No, not really. No.
Okay, so you walk into a Freightliner dealership and you have crappy credit.
No.
Yeah, you have crappy credit. You're not very insurable. You've had some problems, and you buy a brand new $200,000 truck with travertine tile in the bathroom and all this kind of stuff. You're going to go out of business. I mean, there's just you said it in a much more eloquent way when we were in Georgia last week, Dean. But people making bad decisions a year ago, the market kind of let them off the hook.
Mm-hmm.
People making bad decisions now will get penalized for it because the market has tightened back up. That's like whenever the water level falls and you look at the pier or the bridge pilasters and you're like, ooh, I'd rather look at the water.
Bodies show up.
Yeah. So again, I think the people that made sound decisions all the way through it pocketed a whole bunch of money over the last 2 years and now can weather the storm and perhaps invest. Because what's going to happen with used truck prices? They're going to go down. And you'll be able to kind of bolster up your fleet. And then when the market turns back the other way, maybe late this year, early next, you're there to capitalize.
Yeah, but there's some manufacturers that were smart during the peak. Instead of doubling down, they hedged their bets. And so you look at a lot of CPG manufacturers, instead of building their own plants, they went to contract manufacturers as opposed to some others. And Peloton's the poster child, build a massive new plant at the peak demand, thinking it's going to continue on, like Ken was saying, continue on forever. And it's, you're doubling down at the wrong time. But it's easy to say this in retrospect.
Yeah.
Easy to say this in retrospect.
The old disco record sales graph.
Hey, I do have a question. I don't know why it didn't come up. Someone actually just real-time messaged our inbox. How is it possible with the highest diesel fuel price in recent history to have rates like these? I suppose they mean, why are spot rates lower even though diesel's in an all-time high? I suspect that's the question.
Well, it's something you bring up, Ken, right? Higher fuel prices dampen line haul in spot, certainly.
In the spot market, most, if not, the overwhelming majority of freight is negotiated all in. So let's just, I'll go back to my $1,000 problem that everyone on this it's been a few weeks. Everyone can hear it again. You have $1,000 to move a lane, and diesel's $3 a gallon, and then diesel, and again, this used to be like a textbook problem, not with something we thought would actually happen. But you have $1,000 in a load, you move it, and fuel is $200, $800 goes to line haul. 2 weeks later, shipper calls, you book the load, except fuel now has went up $2 a gallon. I have $1,000, I move it for $1,000, and I get $600 for line haul and $400 for fuel. Well, if you look at a graph, line haul went down $200 because I had to double the amount that I set aside for fuel. Now, again, a lot of brokers don't think that, at least not natively, because they're paying $1,000, or maybe it went up a little bit. It went up 15% to $1,150. But with fuel going up so fast, the portion that the driver retains or the carrier retains to cover their non-fuel related expenses gets squeezed. And that's exactly what you see in our fuel adjusted charts. If you look at it all in, rates are the highest they've been. I mean, we're just shy of $3 a gallon, right, Dean? Or $3 a mile.
Correct. Yep.
So if you were a shipper and you were reading about this spot rate stuff, it would make no sense to you. Would you disagree with that, Chris?
No, I agree. But again, for the spot stuff, but most shippers are under contract and they're feeling the fuel, right? And so they're feeling that.
Yeah,
so I
exactly.
think it all rests upon some of the smaller carriers not being as sophisticated in the spot market, not knowing maybe their own costs, because realistically they shouldn't go for $1,000 a load anymore, right? They should think about the price of fuel, but maybe that's hard to do in a highly hyper-competitive market, certainly now.
Yeah, I mean, let's take a hypothetical large truckload carrier like Blight Rift, for example. They would pass that on, right? So their line haul would remain relatively constant, whether it was spot or contract, quite frankly. And then if they had, certainly on the contract side, they're going to have a fuel surcharge. So all their rates would get fuel added on top of it, whatever the prevailing market rate was. And most of the time on the spot side, that big of a carrier either knows their cost or has, even for spot loads, an on-file fuel surcharge with a big shipper.
Yeah,
I remember when we were back up on loads, you had a lot of fuel surcharges in place. Not always, but.
Do we have time
all right?
For
couple more questions. We're running long here.
Yeah. Do we have time for just one more question?
Yeah, let it rip.
Dan Deegan asked, do you guys think that the issue with produce being down in the 20 to 30 percentile is having an impact on other markets with, say, capacity being added, which is not usually available?
I don't know, Dan. I'll have a crack at this. I think it's the opposite of what we're seeing at the moment. It really depends on the market. So, yes, produce season's off to a slow start in the southeast and on the west coast. But it's turned up in the last couple of weeks, so there is volume coming back into the produce markets in both regions. Dry van rates in both regions are generally trending up as dry van carriers with reefers move into the produce sector. So I don't know that it is, Dan, at the moment. Certainly we're off to a slow start and there's plenty of capacity in all markets, but I would say in the last week things have changed, that where we'll start to see both rates go up in both produce market for both trailer types.
Yeah, I want to call attention to that too, right? I mean, the market becomes accustomed to the kind of the cycle within the cycle, right? So you have kind of like your long-term cyclic, but then you have like your annual shape. And that shape is pretty pronounced. I'm drawing on my desk, but that shape is pretty pronounced for reefer. So the capacity shows up, and if the freight is delayed or diminished or has a slow start, you have all this. And again, this is more figurative than anything, but the capacity is looking around going, where's all the freight? every year it's usually shipping these vegetables, which I can't name, that Dean could probably rattle off, that are supposed to be here in Southern California, and it's not here yet. So what do? There's more capacity than there is freight. They compete for lower rates, drives the market down. There you go. So I think it's a kind of a beautiful rendition of the market in action, that capacity comes online, freight's not there, or it's not there yet, drives the rates down. And again, this is all happening short enough term where capacity is not going to exit the market. It's just going to kind of sit around and wait for the freight to come online and then start moving. So ultra microeconomics. All right, I'm going to get us wrapped up here. Dean, quick plugs.
Yeah, I'll be on Radio Nemo on Thursday at 8 a.m. We'll be on with Dan Deegan and TJ Flores on Data Wednesday tomorrow on Sales Chat. You can connect with them on LinkedIn. We're on Landline Now tomorrow evening at 7 p.m. On Sirius XM channel 146. And of course, Chris, we've got a new freight find out this week, don't we?
Yes, we do. Seth Clevenger came out actually last Thursday, writes for Transport Technology. And so we had a really interesting conversation about how technology hasn't changed. One little tidbit is he estimated that the level of technology, sophisticatedness, whatever that's in the cab of an owner-operator is pretty much equivalent to what a Schneider driver had or a top-tier carrier driver had 5 to 7 years ago. So it's really pushed the technology up. It's a great conversation. Also, I will be at Reuters conference in Chicago on the 1st and 2nd of June. I'll be interviewed by Kevin Zwire talking about transportation procurement if anyone's going to be up in Chicago.
Fun. It was great. We have been out and about. It's been kind of brutal on travel, but I know we've been out. Dean's been racking up those frequent traveler points. And I'm surprised, Dean, on your list of plugs, you're not going to be at the small carrier wake here in a few weeks, presenting, lamenting the thousands of unending bankruptcies that are rolling in every single day.
You're just twisting the knife, aren't you? Just twisting it in the wound.
Well, I just thought if anyone's going to be there to speak about it, it would be Dean, but I guess that invite was probably lost in the mail.
I'll be at a truck show with a bunch of other truckers.
That's funny. All right, we're going to sign off. I think we're skipping next week's show for a much-needed R&R. Everyone's been holding down the fort. It's Memorial Day. Get out there and get the hot dogs and hamburgers early, because I think you might not be able to find some of that stuff on the shelf, especially if you're grilling chicken. I know that's in a bit of short supply due to the bird flu, but we're going to sign off for this week. We'll see you in a couple weeks. Hope everyone has a great holiday and a great rest of your week. Goodbye, everyone.
Happy birthday, Ken.